maybe let us repeat a little bit what we did last lectures, and also I think it's good to give you like a more broader picture where we are in this course. Why are we talking about all these things that we are talking about? So the main goal of the entire lecture is to calculate the net present value, right? Because we are thinking about investment opportunities, we want to know what a particular project is worth. But this is a little bit tricky because we are not receiving the cash flows today, we are receiving them in different points in time. So we have learned that the time value of money is very important because at different points in time, money has different values. So we need to discount the cash flows that we get in the future. So in principle, that's really easy. We just look at the future cash flows and discount them. But of course, in reality, it's not that easy because we are talking about the future. We don't know what's going to happen. And most importantly, we don't really know what to use as a discount rate, right? Because usually we say, we look at the opportunity cost of capital, so what else could we do with our money? We could invest in other projects, so we have to look at other projects that are kind of similar to our projects, and that are similar in terms of risk. So we look at projects at a similar level of risk. And that's why we spend so much time talking about risk. We spend a lot of time talking about standard deviation and variances, and I know you all love it. But this is really important, because this is how risk is measured. It's the standard deviation of returns. And the standard deviation tells us how much returns, or stock prices in general, deviate from the average, right? So if there's not much risk, then we can be pretty sure what's going to happen. So we are pretty sure that the expected stock price or expected return will be very close to an average, to a mean, right? But if it's not so certain, sometimes it can be very low, sometimes it can be very high. If you think about the Tesla stock, for example, this is very volatile. Sometimes it's going really well, sometimes it's going really bad. So that stock certainly has a high level of risk, and it has a high standard deviation because the returns are sometimes very far away from the mean. And if you think about our normal distribution that we plotted, probably you remember that the one from Tesla was very Y-shaped, right? Because all the different returns are sometimes very far away from the mean. All right. And then we have talked in general about risk of stocks, but we also have talked about diversification. So if we construct portfolios and are not investing just in one stock, but in several stocks, this can be really good because we can rid of firm-specific or idiosyncratic risk. So maybe you remember the example with the ice cream shop and the umbrella shop. So if it's sunny, the ice cream shop is going really well and the umbrella shop is not going so well. And if it's rainy, it's the other way around. So nobody wants to buy ice cream, but everyone wants to buy an umbrella. Right? So these two stocks were perfectly hedges. So they were perfectly negatively correlated. So the correlation coefficient between the two were -1. Because in general, correlation coefficients are between -1 and +1. -1 means they move in different direction, +1 they move exactly the same, and 0 would be they're just independent. They do whatever they want. They're not correlated, not related to each other. All right, so we learned that when we combine many stocks together, we can get rid of all the idiosyncratic risk. And maybe you remember this figure where we plotted the risk against the number of stocks in our portfolio. And in the beginning it was very high. If you only invest in one stock, we have a high level of risk. But once we add up stock, this line was decreasing, but it didn't go to 0. It stayed at some level because there's still this systematic risk. So in general, if we invest in portfolios with many stocks, so if we invest in well-diversified portfolios, we can basically eliminate all the firm-specific risk and are only left with systematic risk. And this is why, in principle, investors only care about the systematic risk. Because the other risk they can basically get rid of by investing in enough stocks. And this is basically where the CAPM comes in. So the CAPM, where is it? Yep. Starts again from the viewpoint that the total risk of a stock is composed of these two components, systematic risk and idiosyncratic risk. But again, we don't really care about the idiosyncratic risk because we can diversify. So we only care about the systematic part. And then the question is, how do we use the systematic part, this systematic risk? And this is where this beta comes in. So beta is super important, and in principle we could call it whatever we want. We can choose whatever letter. But really, I mean, almost always people choose beta here. And beta is the covariance of a stock's return and the market's return divided by the variance of the market. So we could also write it a little bit different. So here we had, again, the total risk of the stock composed into the market risk and the specific risk. So one share rho is regarding the market risk, and the other share 1 minus rho comes from the specific risk. And again, we don't care about the specific risk, we only care about the market risk. And then when we look at this rho IM times sigma I, so what is this? Rho IM is the correlation coefficient between stock I and the market. And then sigma I is just the standard deviation of the stock. And then remember that this formula here, this one, this is the definition of the correlation coefficient. And I know this is a little bit confusing, and some of you, I think, sometimes mix up the correlation coefficient with the covariance. So this is very important if you think about, or if you want to calculate, for example, the overall risk of a portfolio. You had this component where the covariance comes in. And either you use the covariance or you use the correlation coefficient times, and you put basically this on the other side, times the standard deviation of the stock and the standard deviation of the market. So really keep this in mind, these are two different things. Correlation coefficient and covariance, of course, they're closely related, but you always have to divide by the standard deviations of the stock and of the market. Okay, and then we plugged this in, we did a little calculus, and we came up with exactly this one. So our beta times the variance of the market. And then we talked about beta. So what is this? If beta, in general, which value can beta take? Is it bounded between -1 and +1? No, it's not. It can be basically whatever it is. I mean, it's very unlikely that it's very low or very high, but it can definitely be larger than 1 or smaller than -1. Smaller than -1 is very unlikely, but larger than 1 is very likely. This is very common. And in principle, what does it mean? So beta tells us how much a stock co-moves with the market. So in general, the market has a beta of 1 because it moves, I mean, the market is following or has the market return, so it has a beta of 1. And then all the other stocks are relative to that, are the lower one, smaller, higher than 1. So if they are larger than 1, that means that the stock's return is moving even more than the market. An example for this are very cyclical stocks. Usually these are like luxury goods, things that go well when overall the economy is really going well. I mean, think about if you get a bonus check, maybe you think about what to do with the money, maybe you are going on a very expensive holiday, maybe you buy another TV or things like that you really can afford when you have like extra money. But these are also the things that are first cut if things go bad. So think about if you lose your job, you will still buy food, you will still need to pay for your energy bill, but you probably will postpone a little bit the new watch or the new iPhone or whatever. So this beta larger than 1 means that these stocks go even better than the market if the overall economy goes well, but they also go worse than the market if things go bad. Also tech stocks are almost always have a beta of larger than 1. And it's actually what you could see this week, also the past weeks. I don't know if you follow the news a little bit, also the financial news. So in general, the stock market is not doing that well right now. I mean, there's a lot of uncertainty. There was this huge AI, or is still huge AI debate. There are new models. People are worried that they are going to be unemployed because all of these great AI models. Of course, there's this huge topic of Iran. So there's a lot of uncertainty going on right now. And in general, stock markets didn't do that well. And in particular, tech stocks in these times or scenarios do really bad. Because they are more cyclical, they are very exposed to these risk factors. We will talk about it a bit later in the lecture also. Alright, so you can remember if a stock has a beta larger than 1, then it moves more than a market. And it goes in both directions. It moves better than the market when things go well, but it also moves or performs worse than the market when things go not so well. If beta is between 0 and 1, then in principle the stock moves in the same direction as the market, but a little bit less. So you can think about, utilities is a very common example. Because usually, if you think about an electricity provider, people always need some amount of electricity. It goes up a little bit if the economy goes well, if people go out more, then they also consume more electricity, but the difference is not that big. So in principle, these companies are relatively stable. So they have a beta close to 0. And then there are a few stocks which have a negative beta, which means that they move in the opposite direction. So if the market is going well, then these stocks go not so well, and also the other way around. And there are a few stocks, but they are, quite rare. All right. And then we came to the actual formula of the CAPM. Let me show it here. So this is the formula of the CAPM. It tells us that the risk premium on a stock is equal to the beta times the expected market risk premium. So it follows the market risk premium, and whether it follows more or less depends on the beta. So if the market risk premium goes up, depending on the beta, the stock price or the stock's risk premium goes also up or down, and the beta terms exactly how much it should go up. And when we talk risk premium, this is just the return minus the risk-free rate. Because the risk-free rate, you can think of something that you can always get, no matter what you do. You can just leave your money in the bank account, basically, or you can buy super safe government bonds. And everything on top is the risk premium, because everything on top, you require a return because you take on more risk. So this is why we call it risk premium. So this is just the return minus the risk-free rate. And this is basically everything about the CAPM. The CAPM says the expected risk premium on a stock is equal to the beta times the expected market risk premium. So we can use the CAPM to calculate the expected risk premium or to calculate the expected return of a stock. And then we can use that rate as our discount rate. So this is basically the whole goal of this. All right. So we draw the security market line, which is basically just the formula of the CAPM, and then we put the risk rate on the other side. So we can plot the return, which is here on the y-axis, is equal to the risk-free rate plus something that's related to the beta. So the beta is on the x-axis, and then when we have beta equal 1, we know this is the market portfolio, or the market return. So if we go to this line and then to the left, then this will give us the market's return. And if we have stocks with a larger beta, we get a higher expected return. If we have stocks with a lower beta, then we have lower expected returns. All right. In principle, it's very easy to confuse capital market line and the security market line because they both plot returns and risk, or expected returns and risk. But for the capital market line, it's expected return against total risk of a portfolio. So this also includes idiosyncratic risk. And for the security market line, we really only plot the market risk. So we only plot the beta. So this is very important to distinguish. All right, so maybe let's quickly repeat the basic intuition of a CAPM. So in principle, investors want high return, low risk. So if you remember these graphs that we had, it's basically the same here, but if you plot total, so this graph for the capital market line where we had plot total risk, we always wanted to be in the upper left corner, right? Because we want high returns, but low risk. And then we were talking about efficient portfolios because they gave us the maximized return for a certain level of risk. And then we assume that investors can borrow and lend in the risk-free rate, so they can compute the most efficient portfolio, which is the portfolio with the highest Sharpe ratio. So the Sharpe ratio gave us the relationship between returns and risk. So it's the risk premium divided by the standard deviation. And we want a high return and a low risk, so we want a high Sharpe ratio. And that was the slope of the line. So we wanted the line with the highest slope, which just touched the overall set of efficient portfolios. And that gave us the tangent portfolio. So this was the most efficient portfolio. So everyone wants to invest in that. And if you can borrow land, then you can combine this most efficient portfolio with a risk-free asset. And since we're talking about an equilibrium, we assume that everyone holds the same portfolios, everyone holds the same risky portfolio, which then is the market portfolio. And investors don't hold individual stocks, so they always invest in several stocks in diversified portfolios because we can get rid of this firm-specific risk. And then what's left, what's interesting for us is the systematic risk, which is measured by the beta. So the beta gives the sensitivity of a stock to or a portfolio to market movements. All right. And then at the end, we were talking about whether CAPM holds in the real world, because also if you remember the video, the guy said that some people are not using that model anymore. I mean, in general, it's really widely used. It's the most important model, I think. But it has some drawbacks, because it has quite crucial assumptions, and there are some statistics that, I mean, some things work really well in the data, but some things also not so working well in the data. So maybe let's talk about what the CAPM gets right. So in general, the prediction is that assets with more market risk should earn a higher expected returns. And this is definitely the case in reality. I mean, if you just think about the examples where we looked at the past returns from, I think, 27, it started at 1927. If you think about the development of stocks, government bonds, and treasury bills, then you saw that in the long run, stocks really outperform the others. So the returns on stocks were much higher than the returns on government bonds, which are still higher than the returns on treasury bills. So treasury bills are US 3-month government bond yields, or government bonds. So this is basically the safest asset on earth. So that's definitely true. Stocks with a higher beta tend to earn higher average return. And then the second prediction is that the expected return depends on the beta, not on idiosyncratic risk. And this is also definitely true in reality. So if, for example, companies merge, they don't create value simply by reducing the idiosyncratic risk. Because for investors, it doesn't matter whether the company is diversified or not, because the investor, him or herself, can diversify by investing in other companies. So these are two things that definitely hold. But then there's a little bit less evidence in the data that on the point that the beta should predict exactly how much the expected return increase. Because when you think about our security market line, it says that if beta goes up, then expected return goes up. And in principle, that pattern is true, so high beta stocks earn higher returns than low beta stocks. But if we look at the reality and plot several portfolios, then we rather have a shape like that. So low beta stocks have lower returns than high beta stocks, but the slope is a little bit lower than what the security market line would predict. And what does it imply? It basically implies that low beta stocks have higher return than it is predicted by theory. And if they have higher returns, they have lower prices, so they're basically undervalued. And for high beta stocks, it's the opposite. So they have returns below what the CAPM would predict. So that means that the prices are too high, so they're basically overpriced. And there are several explanations for this. So, I mean, the CAPM is, of course, about expected returns, and what we plot here are realized returns, so there can always be a difference. Then it's really hard to determine the true market portfolio. So usually people use the S&P 500 or in general like very broad indices. And then I think this is the most important point. The assumption is that borrowing and lending can take place at the same risk-free rate. This is a little bit unrealistic. So if you go to the bank and say, I want a loan because I want to invest in stocks, you will probably not get a loan for the risk-free rate. You will pay a higher rate. And what does it mean? It means that if you want to, because in general, people choose the market portfolio and then they choose the risk-free asset. And if they want to take on a lot of risk, then in theory, they just borrow more at the risk-free rate and then they invest more on the market portfolio so that they are higher up at the capital market line. But we have just said that it's not so easy to borrow at the risk-free rate. So for many people this is just not possible. So what do? They want to take on more risk, then they invest in high beta stocks. So these tech stocks, for example. Because they're quite risky, but also expect high returns from them. And if many people do that, and buy these high beta, these risky stocks, then the prices of these stocks will fall. And this can very well explain why the returns then are below this line. So what would be a nice strategy is actually to borrow as much as you can at the risk-free rate, and then to invest in these undervalued stocks, in these low beta stocks, that give returns which are actually higher than what theory would predict what a fair return would be. And this is basically exactly what Warren Buffett is doing. Because Warren Buffett, I mean, he's a super successful investor. I think he retired last year. He owns all these insurances companies, and you can think of this basically as borrowing, because for an insurance company it collects the premium up front, or collects all the fees, and then if something happens it pays the premium later. So this is exactly borrowing, right? And since the business is doing really well, he can borrow a lot at very low rates, and then he's doing exactly, or following exactly that strategy. He is investing a lot in these low beta stocks, and very safe stocks, with low betas that are very safe, do not have super high returns, but of course they have some returns. And since he's doing this on such a large scale, he earns a lot of money. But, I mean, we are not Warren Buffett so far, so it would be a little bit difficult. But in principle, that could be a good strategy. All right. And then I think this is where we left off last week. And then there's another thing that is like a little bit outside what the CAPM is predicting. Because in general, the CAPM says that returns are unrelated to idiosyncratic risk. So all that we care about is systematic risk. But in the data, we see that returns are related to other firm characteristics. So it's not completely irrelevant what the firm is doing or which characteristic the firm has. And two very famous important factors are these two that are plotted here. So the first is that small cap stocks have earned higher average return than large cap stocks. So cap means market capitalization. If you take all the outstanding shares and multiply by their price. So this is the market capitalization, and this is usually used to measure the size of a company. So this red line here plots the difference between the returns of small cap firms and high cap firms. And we see that, so this is plotted from 1927 on, and you see that the red line is increasing. So the returns of these small cap stocks have performed better. But you also see that from the 80s onwards, it's rather flat. So it also seems that the relationship is not as important anymore. And then the second factor, or the second point, is that value stocks earn higher average returns than growth stocks. So what is the difference between value and growth stocks? Value stocks have a very, very high ratio of book to market value. So if you look at the balance sheet, the balance sheet gives us the book value of a company, and then the market value is composed of the stock price times the outstanding shares. So this is also why it's often called high minus low factor. So if you take a portfolio of stocks that have a high ratio of book to market value, and then you subtract the return of stocks with a low book to market ratio, then you get this blue or green line. And you also see that it's upward sloping. So these high book to market ratio stocks have performed much better. And that brings us to today's lecture, which is about the arbitrage pricing theory, or the APT model. All right. So, I mean, again, so the CAPM is still widely used, and it's the most important and most famous asset pricing model. But of course, there are some alternatives. And one important alternative is the APT, so arbitrage pricing theory. And the main difference comes from the fact that the CAPM assumes that there's just one risk factor, one single risk factor, which is the market risk. So we just care about the market risk, so we just care about the beta, and then we multiply it by the expected market risk premium. And the APT now says, no, there might be other important risk factors. So in the APT, there are several systematic risk factors that determine the expected return of the stock. And these can be basically anything. I mean, of course, very important ones might be the oil price factor, interest rate factor, small stock factor, but it can basically be anything. You can just think about which risk is a company exposed to, and then these can all be factors. I mean, you can think of if a company is located close to a river, then you have this flooding factor or weather factor. Okay, so the basic idea is quite simple. It says that each stock's return depends on different macroeconomic risk factors. So we have the return on the left-hand side, and then we have like a constant, which is specific to this firm, and then we have all the different factors. And these B's give us the sensitivity of the stock's return to a certain factor. And then, of course, we have some idiosyncratic noise, because every company still has this idiosyncratic risk, like a lawsuit or something like that. But this theory still assumes we have two sources of risk. So this is common basically to all the theories. We have firm-specific risk that can be diversified away, and then we have the systematic factor risk that cannot be diversified away. So this still holds here. This is like a general rule, if you want. All right. So again, we want to know the risk premium of a stock. So the return of a stock that is on top of the risk-free rate. And this then depends on the risk premiums of each factor. So here, these are the risk premiums. Because it's the return of this factor portfolio, or this factor, minus the risk-free rate. So the expected return of a stock then depends on the risk premiums of each factor, and then the stock sensitivity to each factor. So instead of this one beta, we have here a lot of B's. And the B1 tells us how much is the stock exposed to the first factor. And again, you could, in principle, include infinity factors, because there's an infinite number of risks out there. So what's really nice here, we don't have to think about the true market portfolio, because again, the true market portfolio would include many, many things. Not only stocks, but also bonds, real estate, commodities. So it's really hard to come up with a true market portfolio, and we don't have to worry here. But what makes this theory a little bit tricky to apply in practice, it doesn't really specify which factors matter. Right? And again, this can be an infinite number of factors. So this is a little bit hard to come up with the right factor, the right number of factors. Okay, we will talk about that in one slide. But first, let's talk about two key implications of this APT, this arbitrage pricing theory. So first, if you look at this formula, and if you think about what happens when all these B's are 0, then you have 0 on the right-hand side, and on the left-hand side you have Ri minus Rf. So that gives us that the return of a stock is equal to the risk-free rate. And it makes a lot of sense, because if all these B's are 0, that means the stock is not exposed to any of these risk factors. And if a stock is not exposed to any risk, it's a risk-free asset. And then, of course, it should give us the risk-free return. And this is basically actually where the name comes from, because you can think of if the return of a stock would be higher than the risk-free rate, although it's not exposed to any risk, then you could make some profits by just buying this asset and selling the risk-free rate, which is risk-free. And the risk-free profits are basically impossible here, because this is what we call arbitrage. And in general, arbitrage is not possible, because there will always be someone in financial markets making use of this opportunity. And there will always be someone that is faster than you. So since arbitrage is not possible, the return has to be equal to the risk-free rate if all the B's are 0, if there's no risk. And this is where the name arbitrage pricing theory comes from. And then the second implication is that the expected risk premium of a well-diversified portfolio is proportional to its factor sensitivities. So it sounds a bit complicated, but it's just if you look at all the what is inside the portfolio and you look at the factors that all the different stocks are exposed to, then the overall risk of your company, of the portfolio, sorry, is proportional to the risk factors that the single stocks are exposed to. So it's basically just a weighted average of the risk. Because here we're only talking about systematic risk. Right? So if you have a higher exposure to risk factors, then you expect a higher compensation. Again, always if you take on more risk, you expect a higher compensation. And if you don't have any factor exposure, then there's no risk premium. I mean, this is basically the point, the first point. If there's no factor exposure, means you're not exposed to any kind of risk, then it's basically the risk-free asset, and then you expect the risk-free rate as a return. All right, so in principle, the APT applies to well-diversified portfolios, where the firm-specific risk is diversified away, and only the factor risk remains. So only this systematic risk remains. Sorry. But if this pricing relation holds for diversified portfolios, it must also hold for individual stocks. Because otherwise you could come up with a nice combination of stocks, which then gives you again risk-free returns, which by these arbitrage assumptions is not possible. So each stock must offer an expected return in proportion to its contribution to the factor risk. It sounds a bit complicated, but it says basically that this formula applies to single stocks. So the expected return of a single stock is equal to the expected risk premium of the factors times the stocks or the firm's exposure to these factors. And I know it sounds a little bit abstract, but we will practice this in a few minutes. All right. Okay, so how is this done in practice? Because in theory it sounds nice. You look at different risk factors and then you compute the sensitivity, so you look at past returns to compute the sensitivity. But of course it's not so easy, because this theory doesn't tell us which are the relevant factors. So you have to look at the data, you have to run complicated statistical models that give you the past exposure of a company to certain factors. But of course there are some people who have done this, and there are some models that are used in practice more often than others. And I think the most important or most famous model is the so-called Farmer-French three-factor model. So Farmer-French were the two researchers who have invented this. And they basically say, okay, we have three factors that are the most important ones. Again, in principle you can have an infinite number of factors, but it's not a practical reality. So they have found out that there are three factors that explain already so much that you don't have to care about the others. So the first is, of course, the market factor. It still remains very important. This is what we had in the CAPM, and then, of course, it's very important. But they add two other factors, which are exactly the ones that I showed you on the last slide from the CAPM. So the small minus big factor and the high minus low. So again, the small minus big factor is the returns of small stocks minus the return of large stocks. And the size is always measured in market capitalization. So this is the first important factor, because historical data just showed us that there is a systematic difference between these two types of stocks. And the second factor is high minus low. So the return of high book-to-market stocks minus the return of low book-to-market stocks. It's basically value stocks minus growth stocks. And then they have, so this here on the bottom is this three-factor models. You have on the left-hand side the risk premium of a single stock, and on the right-hand side you have these three factors: the market factor, the small minus big factor, and the high minus low factor. And then the B's give you the exposure of the stock to the certain factor. So if, for example, a stock very exposed to the market factor, so the market is enough to explain the stock, then this beta will be, this B market will be very high, and the other two B's are very low. All right. But of course there can be other factors, right? And one important factor is, for example, the sustainability risk factor. Because of course sustainability is a huge topic. Sustainable financing is a really big topic, really big market. I mean, in principle in this lecture we don't talk so much about sustainability because we have to cover all the theories first. And I saw that everyone will have a class specifically on sustainable finance or sustainable business it's called. So we only talk a little bit here, but of course it's a super important topic in finance. But the APT is a really nice opportunity to talk about this. Because if you can think about climate or transition risk, this is definitely a systematic risk. This is like a huge development going on, basically affecting almost every stock. So we can definitely think of this as its own risk factor. And then you could just add this to this 3-factor Farmer-French model. So here the risk premium of a stock is given by these 3 factors that we had before. The market factor, the SMB factor, and the high minus low factor. And then you can add the sustainability or ESG factor. So the ESG factor gives us the market price of sustainability risk. And in principle, you can think of 2 possible channels. So first, this is really the risk channels. If you think about firms, how exposed are they to this climate transition risk? So if they have a higher exposure to climate transition risk, then you would also expect higher returns. And this is especially true for what you call brown firms. So if you think about brown firms, they are very subject to stricter regulation, and this regulation becomes stricter and stricter. So for them, it becomes quite hard to still be profitable. Of course, this is a huge risk for these stocks. So you would only invest in these kind of stocks if you expect a higher return. Otherwise, why should you invest in these stocks? But then in reality, there is a second channel which is not really captured by this model, because the model really looks at risk. But of course, in principle, there can also be something like a preference channel. Because since a few years, investors really seem to prefer green assets. So it seems that in principle, they are so popular that many investors buy them, that the price go down, but they still buy them because they want to buy these stocks because for regulatory reasons, because they think they are safer, because they are not exposed to this climate risk. So maybe in the future, when these other stocks became really bad because it's so hard for these companies to perform, it might be really good to have these green firms. So there are many reasons why these stocks are popular. But it can be that actually investors accept lower expected returns. And which is good for these sustainable firms, because then they have a lower cost of capital. Right? If everyone wants to buy their stocks, then they can sell shares of the firm for a very high price. So in principle, we have these 2 channels. But what comes out of the APT model is this risk channel. If firms are more exposed to this ESG or sustainability risk factor, then investors are expecting higher return, because otherwise they don't want to invest in the stock. So in principle, sustainability can definitely affect asset prices through risk, but also through investor preferences. And if you think about it, actually also the recent development in Iran can be also related closely to the APT model. Because you could also add to these types of model another factor, like a geopolitical risk factor, for example. And if you see at stock prices of companies on this Monday, also last week, because it was kind of anticipated, then you see that firms perform quite differently. I mean, overall, stock markets didn't do that well, but there are firms that performed especially bad, or there are even stocks that perform quite well. And in principle, you can just think of what a certain event brings with it. I mean, if you think about Iran, of course, it has huge implications for energy prices, which then has implications for inflation risk, which then has implications for interest rate changes, because it might be the central banks are reacting to increased inflation expectations. And then you have to think about how exposed are different companies to these different types of risk. I mean, for example, tech companies are usually quite exposed to interest rate risk, because they really depend on outside capital. And if interest rates go up, then discount rates increase quite a lot, and this is particularly bad for these types of firms. but they're also quite exposed to overall sentiment. And if there's a lot of uncertainty going on, then investors become less optimistic. And then something happens that is usually called as a risk-off event. So if, in general, uncertainty is high, investors don't like risk anymore, and they go out of rather risky assets. And this is, these tech companies are quite risky, because usually they don't have so many profits right now, and everyone invests in them because they believe in the future they're going to perform really good. But of course, this is very risky, right? So these type of stocks maybe are very exposed to this sentiment factor. And then other stocks are very exposed to the energy price factor or oil price factors. And there are, of course, some companies really suffering, like airlines, for example, they're really suffering. If oil prices go up, they're also suffering right now because the entire air traffic was disrupted quite a lot. So most of them performed really badly. So we can think of them being quite a lot of negatively exposed to this oil price factor. But then there are also some companies which are positively exposed to the oil price factor. So they have a larger and positive B in front of this oil price factor, and these are energy companies, for example. Right? So in principle, you can just think of what can happen in the world, what implication brings this, and what is the risk that a company is exposed to. And then you can call them factors, like oil price factor, energy, interest rate factor. And then you think of how much is your company exposed to this factor. Okay. And then I think we take a break now, and after the break we will practice this a little bit. And it would be great if the class representatives of all the programs could quickly come.